Wow, what a difference a week makes. Hey everybody, welcome to this week's TradeSmith, the weekly video newsletter for Monday, June 19th. And of course, this didn't change at all. It's the same as last week and the week before and the week before. Live it, love it. All right, let's talk about what's going on here. So here we have the S&P 500. And you can see that it's staggering sideways. It's not really going up. It's not really going down. But the purple predictor, which has a tremendous track record, is showing weakness, which suggests that the smart money is getting out of the S&P. So we have to count that as bearish. We don't want to be in an aggressive mode at this point. Now, at the same time, we're creating a little consolidation here, which could go either way. But right now, I think it's going to drift lower. The Dow Jones drifting higher. Remember last week I talked about we've seen a major sector rotation. And now we want to be in Dow-type stocks and out of NASDAQ-type stocks. So here you can see that the Dow is grinding higher. The S&P was stable. But here we can see that the NASDAQ is cracking down. Let's take a look at it. One bullish feature is the purple predictor is supportive of the NASDAQ. But I put a almost horizontal line near the top there, which shows that there was a big momentum divergence, and that's what caused the drop. And then look at down at the bottom. Every time there's a big drop, we're seeing a big volume. So that supports the bear case as well. But the point is that even if this was bullish, it's not as bullish as the Dow 30. So we need to get out of those sexy high-tech stocks. We need to be focused on boring old industrials. Seasonality, our seasonality indicator is still bullish. It's not even close to turning bearish, which is fabulous because it means that all of the profitable trades for the fully paid up members are all double-sized trades. You can't beat that with a stick. Seasonality. Now, you can see that we're in a period in June which the market should be under pressure. No matter what scenario you pick, we should be under pressure until at least the end of June. So don't look for any big rallies here right now. The yield curve also putting pressure on the market. Asset allocation is who cares? It's just drifting sideways. And what that means is money is neither flowing in or out of the bond or stock market. They're just equal. Our risk indicator, a little bit of an uptick, which is a little teeny bit bullish, but not much. Global shares are starting to suffer the same way that the U.S. shares are. Notice that the price action for almost 2 weeks now, we've been going down, and at the same time down at the bottom, we're seeing the volume go up. And so the volume is confirming the down move. And then if you look at the first week in June, as the market was climbing up to those new highs, the volume is going down and was not confirming the rally. So to me, it looks like we're just going to drift lower here in global shares. I don't really have a position anymore at all. Emerging markets, I still am a little bit bullish here, but I got out of all of my emerging market shares in a week ago. So I'm no longer here. I don't like the purple predictor, so we need to be out of emerging market shares as well. But Greece. So this is something I was bullish on it in the past. I know I keep saying it, but it's going to be the best stock market around. And so far, that's the case. Look at what happened the last couple of days on super heavy volume. For our fully paid up members, I'm going to get long Grec right now. Fully paid up members, of course, will get the exact trading strategy. But for you freebies, look at your portfolio and decide if this fits in your portfolio. Treasury notes, green all over the place. Look up at the top, two big gaps. Now, the first gap occurred 3 weeks ago, and the market came down and actually broke through the bottom of that gap, which is a little bit bearish. But the purple predictor remained on a bull signal. Down at the bottom, the gap we just got last week was on heavy volume. So, number one, either this thing's going to take off to the moon, or this is the high in the market. But let's take a look at our next slide. And here we see, if I could get to our next slide, that would be spectacular. Somehow or another, we'll get there, don't worry. There we go. Our key factors. Now let's look at these in a little bit detail. The green line shows 10-year Treasury note yields, and you can see that they're going down. Now the gold line is the price of gold, and it's going a bit up, so it's suggesting higher interest rates. What's traditionally been the most important factor is the blue line, which is 10-year treasuries in Germany. But you can see that the gap, that the U.S. rates are coming down and German rates are staying the same. And that's one of the reasons why the U.S. dollar is suffering so much right now, is that interest rate differential, which was insanely bullish, is no longer insanely bullish, merely bullish. But look at the chart down at the bottom. That shows the CRB index, and it's telling everybody that inflation is going to be low. That even though we got to perk up in a lot of inflationary indicators in the first quarter of this year, the second quarter of this year is like, forget it. You know, we're not going to reach the Fed's 2%. We're going to stay at 1.5%. And I think that is the biggest factor causing yields to come down. And at this point, we'd have to say they're going to continue to come down. Fully paid up members, when we get to our analysis of the commodities market, you'll see that overall, they're all in bear. They're pretty much, most of them are in bear markets, which suggest lower inflationary expectations. So the dollar, I think we'll get a pop up here to that downtrend line, the upper downtrend line this week. A little bit of a reflex rally, but the bottom line is that diminishing interest rate differential is going to continue to weigh on the dollar. So this is a change in my beliefs. Gold, if the dollar pops up, we should see gold go down. So look for gold to go down to the 1220 area, that uptrend line. It's not that this is bear market, that this sluggish bull market is over. It's just that we're going to continue to probably remain under pressure. Now, I may consider buying gold down around 1220. Let's talk about it next week, shall we? And our short-term indicators, though, 2 out of 3 are bearish. And that's another reason why gold should continue lower this week. Now, oil worked exactly as I predicted last week. We've gotten down into that 44 range. You'll notice that what's happening is on the down moves, volume goes up, and on the up moves, volume goes down. So looks like we're going to first, we sniffed out the lows that we made in early May. We might get a little bit of a rally here, but I think we're going to go down and break through those lows that we made. So in other words, look into maybe 42, 41 a barrel. It's just way too much production, and the demand is not going up at all. So we need to remain on the short side in oil. All right, everybody, listen, all you freebies, we'd love to have you subscribe. Go to that website up at the top, bit.ly/weekly market forecast. And yes, you have to capitalize weekly market forecast. And you know what you get. It's just super cool all the time, but it's only less than a Starbucks coffee. So how can you go wrong? All right, fully paid up members, hang in there just a second. Freebies, love having you. We'll see you later.